안녕하세요. 미국주식으로 은퇴하기 미주은입니다. 미국 주식에 투자하고 계신 분들이 꼭 만나고 싶어 하실 만한 미국 주식의 고수분들 혹은 각종 산업 분야의 전문가들을 제가 여러분들을 대신에 만나 뵙고 그분들의 훌륭한 인사이트를 들어보는 시간 미주은이 대신 만나러 갑니다가 방송되는 날입니다. 오늘은요, 조금 특별한 방송을 준비했는데요. 최근 CNBC 뉴스에 등장할 때마다 최고의 시청률을 기록하는 룹펀즈의 매니징 파트너 진머스터를 모셨습니다. Hi Jin, how are you?
Doing fantastic. Great to be back.
It has been a while since we spoke last time. How's everything with you and your family?
Everybody's doing fantastic. Thank you.
There have been a lot of requests from my subscribers to invite you back to my channel. Thank you so much for joining us today.
Thank you.
For the audience, it is 6 a.m. in your time. So I guess you are one of those early birds, is it right?
I do. It's actually 5 a.m. Where I'm
Is
at
it?
today, and I make it a rule. I'm always in bed quite early. I would just say that this is I think it's important to be in bed early, and of course that means always getting up early.
All right. Well, maybe I should follow your lifestyle because I believe we are in the same age. I believe from last time. I will.
51. Yep.
Yeah, yeah. 51. I'm 50, so we are almost the same.
Nice.
Um, so you have a very healthy lifestyle.
Keep it simple, yeah. Don't take the bait at night when you're tempted to watch one more video. Just say no and get some sleep. I think it's paid off. Before 2020, I used to travel and didn't have the benefit of sleeping as much, and I find it quite just mentally, you're just in such a better place when you get sleep. I mean, it's
Mhm.
obvious, but it's a discipline though. Trying to create time for space for sleep. It's also a huge luxury to have
Mhm.
the ability. A lot of people have to work two jobs, and they can't afford they just don't have the luxury of sleep. So highly recommend it. I always like to say is that your day starts the night before.
Absolutely. Yeah, yeah, yeah. I totally agree with you because I had this bad habit. When you go to bed, I open YouTube and watch your video.
Oh, nice.
That
You can turn it off. That's okay.
sure will do. Um, can you kindly introduce yourself to the audience who did not watch our first collaboration last time?
Sure. Gene, I'm a managing partner at Loup Funds. We've been around for 5 years. The team that I have been building Loup Funds with, we've been together for over 15 years, and we've been researching and investing in transformative tech, both in the public and private markets. And so we have multiple funds
Mhm.
that really try to address where the world is going. We are a curious bunch, and we obsess about how technology is changing the future. We also, at certain pitch points, obsess about what's going on in the near term, what the Fed's doing, what's going on with the economy, and I think we're in a period now where we're thinking about both of those, not only what's going on with the future of tech, but also what's going on in terms of the economy and the Fed.
Mhm. I have visited the website of Loop, and there was one saying we invest in frontier tech companies, automating the world and building new ways to experience it. So you just explained why you pay attention closely to tech companies. Do you also believe that there are bigger investment opportunities in the technology sector?
I do. I've been, tech has been a part of my investing career. And so I genuinely believe that if companies are not growing, they're dying. And so tech, just by nature, by its transformative nature, by its gaining a market share nature, has a growth dynamic to it.
Mhm.
An obvious example, of course, is what's happened with Tesla. The auto industry was effectively a dead industry, and it's a large industry too. It's a $2.5 trillion addressable market.
Sure.
That, to put that in a perspective, is that the smartphone market is about a $1 trillion market. So we have something that is 2.5 times the size of the smartphone market. But that is an example of a market that would not be appealing to us, the auto industry, but it's very appealing when you put it in the context of tech transformation, because it creates these new companies and new business models, potentially more profitable business models that create investment opportunities.
Sure. Yeah, let us talk about Tesla a little bit later. But today, considering the current market situation, I think we need to start with macro storage first. I would like to listen to your expectations regarding inflation and recession. First of all, when it comes to inflation, do you see? We can see that the oil price has gone down more than 20% in the past months. Do you believe the inflation has peaked already?
Today, middle of July, my sense is that it has peaked. I think that the number for June will show an acceleration from what we saw in May. The CPI number in May was 8.6%. I suspect that it's going to be higher. I think that the market generally believes it's going to be higher too, because those oil prices peaked in the middle of June. So there is going to be a dynamic. One thing that is a little bit comforting about this CPI number is that investors, I think, are going to be focused more on the core CPI number. The core CPI last month, for month of May, was 6%. In the month of April, it was 6.2%. So it actually showed an improvement. The core CPI excludes essentially energy and food. It's, I think, a better reflection on what the Fed can actually control. That I do believe needs to show an improvement, and will show an improvement. I suspect it will be 5.9, a fractional improvement. So the one silver lining to this CPI number, a lot of anxiety around it, comes out on July 13th. A lot of, I think one silver lining is that people will be more focused on the core number. And even if it's an ugly number for the underlying, the general CPI number, I think the Fed, most importantly, is going to start to say, yes, it's hot, but it's not as hot because things have started to improve. And where that leads us ultimately for July 27th, during the next Fed meeting, I think probably leaves us at 75 basis points again, with some commentary about potentially pausing after that.
I see. So we are on the process of picking up, and at least when it comes to the core CPI, we might see some downturn in the
I think
near
we'll see
future.
another month of improvement. Another piece to it too is just a lot of the economic data in the U.S. has showed some decelerations. We're, of course, seeing commentary from big retailers about growing inventory levels. They're just are starting to see some signs of some slowing. And so I think that you put that together, and I think that that should yield a core CPI number that is a slight improvement. And the market is hyper-focused on every 1/10 of a basis point here.
Yeah.
And so we are, I think I'm optimistic that we're going to start to show some improvements. That said, we're sitting in front of what is going to be, I think, a wild and quite negative earnings period for a lot of these companies.
Yeah, sure. You just mentioned the negative period for earnings. So let's talk about the recession risk then, because last Friday, just a few days ago, we have seen the June job report showing very strong labor market. But on the other side, Atlanta Fed GDP now, a tracker is indicating a minus growth for the second quarter. So we have two different indicators going to the opposite direction. Do you believe soft landing is possible at all?
No, I don't believe a soft landing is possible. I don't think the market is expecting that. I don't think the equity market is expecting a soft landing. In part because I think one of the reasons why that labor number was better than expected is because there still is a labor shortage. And so there still is some room to make up on those hiring, while the overall economy is starting to show some signs of slowing. It's just a very difficult dynamic to try to engineer a soft landing. Part of the reason is that I just feel like the spike in rates, we're just starting to see the impact on that. And the big spike came, of course, in the middle of June. And so we're, call it 3 weeks into that. And that has a profound impact on, I mean, it really hits hardest at the top, the most expensive goods, homes, and vehicles and cars.
Mm.
And when I think we're just starting to see that. We saw last week that the inventory of homes, it's been declining for the last couple of years. We saw it start to move up for the first time. You're starting to
Okay.
see more price reductions on homes. All of this has a trickle down effect on the broader economy. Specifically, you look at home starts, you start to see a decline in home starts. You've heard some of the home builders talk about some of the challenges that they're seeing,
Mm.
and that impacts less home starts, impacts everybody, impacts commodity pricing. There's a lot of people who are employed there within that industry, and the same in the auto industry. So you start to see these higher interest rates can have really a profound impact, not to mention
Mm.
businesses that are starting to think about expanding, that now these rates are going up. Going from a 2.5%, that's where it was. That was a 30-year mortgage
Mhm.
a year ago, going
Yeah,
from 2.5 to 5.5%. That is a significant jump for
of course.
a
Mm.
typical buyer.
Mm, mm. Right. So you are expecting that there could be a recession, and some of the investors are worried that because of that recession risk, we might experience a major bear market similar to a dot-com bubble in the early 2000 or a global economic crisis back in 2008. What do you think about this kind of a pessimistic opinions? Do you see that big drop from this point forward?
I've been negative for a better part of a year, and I think that we're getting close to the end of the negativity despite all of that. Despite the fact that we're likely in a recession, I think that the market view, the flashlight of the market looks at this point into 2023 in 6 months in advance. And so that is one piece that is somewhat comforting here, is that to answer your question, do I believe that this could be another 2000? Let me just quickly talk about what happened in 2000.
Sure.
The market was down 75%. The NASDAQ was down 75% in 2000, 2001, and 2002.
Mhm.
2000 was a horrible year. I think it was down like 40%. And at that point, probably a lot of investors said, like some myself say now, that we're close to an end. And then you're hit with another down, call it 30% year, and then a down 25% year. And so that is a quite concerning analogy. The challenge is that in 2000, the forward price to earnings growth, that was in 80 times. We're right now, the NASDAQ right now is at 21 times.
Mhm.
And it bottomed, the .com bottomed at about 18 or 19 times. And so we have more companies essentially in these high growth markets that are more profitable than we had in 2000. And I
Mhm.
think that that has a measurable impact, and kind of, I think, softens what potentially this downside could be. I think there is more downside. All that's optimistic, but I think we're not at the bottom yet.
Mhm.
And
Mhm.
the reason why we're not at that bottom yet is that I think we are squarely in front of, in the next few weeks, what's going to be just a really disappointing earnings period. And I
I
think that
see.
the commentary could spook and scare some investors to think that this recession is going to last longer than most think.
I see. So when it comes to a multiple, we are already at 21 times for the Nasdaq, which means maybe the downside risk is limited, but we still have a earning issue. So for next at least 3 months, we might have some earning shock from different companies, and we might go down more. But which means we are bottoming up then. Yeah, that is a part of the bottoming process.
Correct. We're getting close to the bottom, and you bring up important point is that price to earnings is price and earnings. And if we're talking about some downward earnings revisions during the June earnings report and the outlook for September and December, that stocks can continue to go down. So I think that investors should. This is not investment advice, but I think that my view is to think about this in the context over a 2-year period. And I think that, over the next 3 months, we're going to be kind of placing the bottom in the market. And I think the setup for 2023 is good, and 2024 is more neutral. But 2023, I think the setup for tech is good. But yeah, we're not there yet. Basically, every company is going to have something negative to say about September. And it's game theory, but they would be foolish not to say something negative. And so I think that, yes, some of that gets priced in. And that's why I think that you can start to nibble away at some of these positions, because that's where I could be wrong, is that all this negative commentary comes out and the stocks go up.
Sure. When you were on my channel back in April, you said you were holding 50% cash. Are there any changes? Are you still holding 50%?